Your paycheck is probably gone before you even touch it. You are not working for future freedom anymore. You are working for promises you already made months or years ago. Today, we are breaking down the cycle of high-income poverty and the invisible fixed cost trap. This is for the person who earns a decent salary but still feels pressure every single month, no matter how much money comes in. Freedom is not about how much you make. It is about how much of your future income already belongs to someone else. Let's look at the math behind the trap. Assume a household earns $8,000 per month. They have a $2,500 mortgage, two $700 car payments, $400 in insurance, $300 in subscriptions, and another $600 in student loans. Before they buy groceries, fill up the gas tank, pay utilities, or handle a single emergency, $5,200 is already gone. That means 65% of their gross income is committed before real life even begins. Every month becomes a race against obligations. Now imagine their income drops by just 20%. Maybe overtime disappears. Maybe commissions slow down. Maybe one partner loses a job. Maybe the economy tightens for 6 months. Suddenly, the entire system starts breaking apart. The problem is not coffee, takeout, or small daily spending. The real danger is building a fixed lifestyle with zero room for reality. They are one bad Tuesday away from financial panic because they traded flexibility for monthly payments. Rule 1: fixed costs create permanent pressure. The $500 car note, the $180 phone bill, the upgraded apartment, the premium insurance package, the financed furniture, all of it slowly starts feeling permanent. Not optional, not temporary, just normal adult life. Society rewards visible fixed costs. A bigger house signals success. A luxury SUV signals status. Nobody sees the pressure underneath those payments. They only see the image. Keep your must-pay obligations below 40% of your take-home income. That creates breathing room. Margin is not laziness. Margin is survival. Open your banking app and list every recurring payment tied to autopay or a contract. Do not estimate. Write down the exact numbers. Rent, mortgage, car payments, phone plans, insurance, subscriptions, loans. Most people underestimate their real monthly burden because the payments are fragmented across dozens of apps and accounts. Pull them together into one list. If your rent and car payments alone total $3,000 per month, you should ideally be bringing home at least $7,500 after taxes to maintain stability without constant pressure. And even then, the goal is not to stay comfortable forever. The goal is to eventually reduce those obligations so your income gains more freedom over time. Rule 2: flexibility matters more than appearance. You buy the maximum lifestyle the bank approves. Instead of asking, "What gives me freedom?" people ask, "What monthly payment can I survive?" The car dealership asks what payment you want. The lender asks how much house you qualify for. The furniture store offers 0% financing. Everything is designed to normalize permanent payments. Banks are designed to calculate capacity, not safety. They tell you how much debt you can technically carry, not how much pressure you should voluntarily accept. People end up optimizing for appearances instead of flexibility. But flexibility is what protects you when life changes unexpectedly. Pay for flexibility. Choose options that let you leave, downgrade, pause, or reduce quickly if your situation changes. Freedom has value. Sometimes the financially smarter decision is the one that keeps your exit doors open. Find one contract you can convert into a month-to-month setup or downgrade immediately. Ask yourself one question. If my income dropped tomorrow, how fast could I reduce this? That question changes everything. Rule 3: high income can hide structural weakness. You assume a high salary automatically means financial health. So the raises come in, and the obligations quietly grow with them. Bigger home, nicer zip code, leased luxury vehicle, more expensive vacations. Your income rises, but your flexibility disappears. A lot of high earners are not financially strong. They are simply carrying larger financial structures. Lifestyle inflation happens slowly. Nobody wakes up intending to become trapped. The upgrades arrive one at a time, and each payment feels manageable in isolation. A slightly nicer apartment, a better car, a more expensive gym, more convenience spending. But eventually, your entire financial system depends on maintaining peak income forever. That is fragile. Stress is not just about income, it is about dependency. Rule 4: monthly payments compound psychologically. This is the death by subscriptions problem. $12 here, $18 there. Another $25 upgrade. A forgotten app. A streaming service nobody watches anymore. Individually, the numbers feel harmless. Together, they quietly drain control from your life. The problem is not just financial, it is psychological. Every recurring payment creates background pressure in your mind, even when you stop consciously noticing it. Modern digital services are intentionally frictionless. The easier it is to forget the payment, the longer you keep paying. That is the business model. Autopay removes awareness. Convenience removes resistance. And eventually, wants start feeling like permanent needs. Use the manual pay rule. Turn off autopay for anything that is not a true core utility. That small friction changes behavior fast. Because the moment you have to manually click pay, your brain starts reevaluating whether the service still deserves space in your life. Open your subscriptions list right now and cancel 3 services you have not used in the last 30 days. Not maybe later, today. Do not start with emotional items. Start with easy wins. Unused apps. Duplicate streaming services. Premium memberships you forgot existed. Build momentum through removal. Canceling a few small subscriptions may not change your entire financial life overnight, but it reduces mental clutter and restores a sense of control. Rule 5. Lower the floor before raising the ceiling. Most people try to solve financial pressure by earning more money. New side hustle. Extra overtime. Second job. Promotion chase. But they rarely reduce the obligations creating the pressure in the first place. So every extra dollar simply feeds a system that already became too expensive. Making more money feels exciting. Cutting expenses feels uncomfortable. But income can disappear. A lower burn rate stays with you permanently. Apply the aggressive cut before the aggressive earn. Lowering your financial floor is often more powerful than increasing your ceiling because savings are immediate and taxes do not reduce them. Every recurring payment you eliminate permanently improves your flexibility. Call one provider and reduce the bill. Insurance, internet, phone plan, gym membership. Negotiate it. Downgrade it. Remove it. Most companies already expect customers to negotiate or cancel. That is why retention departments exist. This is the strange paradox most people eventually discover. The more stable your lifestyle looks on the outside, the harder it becomes to change your life. People build cages out of respectable payments. Good credit. Reasonable loans. Affordable financing. Normal adult obligations. And then one day they realize they cannot take a risk anymore. They cannot leave the job. They cannot start the business. They cannot move cities. That is not real stability. Real stability is having low enough obligations that your life does not collapse if your income changes. A high credit score is not freedom. The ability to walk away is freedom. This week, map your full burn rate. List every recurring payment: mortgage, rent, cars, insurance, subscriptions, debt, phone plans, everything. Then total it honestly. Do not round down. Do not ignore annual subscriptions. Do not pretend temporary payments do not count. If money leaves your account every month, it matters. This month, reduce your fixed obligations by 10%. Cancel memberships. Downgrade plans. Sell something with a high monthly payment. Create breathing room. The goal is not perfection. The goal is momentum. This year, eliminate one major trap payment completely. A paid-off car. A finished personal loan. A cleared credit card balance. A removed financing plan. The goal is not to look rich. The goal is to reduce the number of things that own your future income. Which recurring payment gives you the least flexibility right now? What specific bill feels the most like a trap and why?